Hello, everyone, and thank you so much for joining us today for our next in the series of conversations from the edge brought to you by Digital Asset. With these discussions, as you might know, we get the expert insight and perspective from industry leaders and organizations who are driving innovation across the financial ecosystem with smart contract and distributed ledger technology. And today, we have three such leaders focusing on the development of exchanges and platforms that will enable and transform digital corporate finance activities. We're privileged to have here today Tom Sullivan, who is the head of US Market Access and Business Development for SocGen, John Palmer, who is the president of Cboe Digital, and my colleague, Simone Letort, who is the head of strategic initiatives at Digital Asset. And with that, we'll get right into it. Gentlemen, if I could ask you, just when you start, if you could give a little bit of background on your own organization. In fact, why don't we go around the table and just do that first, just to get a few-minute intro to acclimate our listeners into what your organizations are doing. And then we'll start with the questions for today. So, John, do you want to start with Cboe Digital?
Yeah, and thanks, Kelly, for having me today. Really looking forward to the conversation. So Cboe Digital is the digital-focused arm of Cboe Global Markets. We operate markets globally, 25, 26 different markets, 18, 19 different jurisdictions from a regulatory perspective. And Cboe Digital is focused right now on spot and derivatives, cryptocurrency exchange, and most recently with tokenization.
Great. Thank you so much. Tom?
Hi, good morning, and thanks so much for having me. I'm really looking forward to this conversation. So SocGen is a large financial institution based in France, obviously, and we've done a lot of work in the digital asset space. And in fact, SocGen has a standalone legal entity called SG Forge, which is focused solely on the digital assets in the capital market space. So we've been spending a lot of time working on delivering products directly into blockchain environments and focusing on how we can build the ecosystem to build a robust capital markets infrastructure in the blockchain and digital asset space.
Great, thank you as well. And Simone, you want to spend a minute just on our own organization?
Sure. So Digital Asset is a software development company focused on blockchain and distributed ledger. We have our own smart contract language called DAMO and our blockchain protocol called Canton. And we're really focused on the capital markets, financial institution space, where we help people like Cboe and SocGen and many others build a distributed ledger application to digitize the financial ecosystem.
Great. Okay. Well, so hope everybody listening now can appreciate that you all are actually the leaders in the industry, and your expertise and the insight shared today is going to be really fabulous. So, Tom, let's start with you. SocGen, and you just mentioned a moment ago, SG Forge, have made considerable effort in creating digital capital markets activities and paving the way. Frankly, I think something else you're known for sharing the feedback very openly into the industry and really elevating the level of information and discussion. Not all of the folks listening in may be fully aware. Can you share an overview of what you're doing, expand on what you've just said in the digital financial services space?
Sure. So in fact, SG Forge is, as I mentioned, is a standalone legal entity. It was formed about 5 years ago, interestingly, out of an internal startup. So it was treated as a startup that SocGen funded, and it was really created with the idea, as I mentioned, that capital markets can and should function and function better in the blockchain and distributed ledger environment. And so over the course of time, SG Forge has done a number of groundbreaking transactions, and I say that as a relatively recent joiner of SocGen Forge. I started with the team a year ago, so I can't take credit for a lot of the work that the team has done. But there have been somewhere in the neighborhood of 25 transactions that the team has initiated. Most of them have been, in fact, on public blockchains. But we take a view that we are agnostic to which platform we are on. We are looking for the right environment with the right control set to be able to, and with the right partners so that we can engage in this space. And so I mentioned that there's been 25 plus transactions. Most of them have been focused on notes issuance and fixed income type products, where we see the most appetite and the clearest path to begin this journey. But we've also done a number of really I would say groundbreaking things. In April, the team launched a stablecoin in Europe called Coinvertible, and most recently last week was granted a digital asset service provider license in France. So we think that there's a promising future in the space, and we're really looking forward to the work that DA is doing and Cboe is doing. So I think that it really goes nicely with the things that Societe Generale is trying to do.
Great, thank you so much. Actually, it's a nice lead in to John as well, because John, similarly, Cboe has advanced focus on the opportunity to provide a platform and services for creating and issuing tokenized assets across different types. Can you share a bit of insight on your strategy for new capital markets infrastructure?
Yeah, and I think a lot of it ties into exactly what Tom said. It's really where are we going with the future? As I mentioned, we operate markets globally in a lot of different asset classes. And so looking at, with kind of step one, getting into cryptocurrencies via Cboe Digital is really just the start. It's really how do we leverage distributed ledger technology and different blockchains in terms of how we're going to move the industry forward, right? What types of assets are the first types of assets we should look to really digitize beyond, call it what cryptocurrencies are, and how do we see our markets move into and leverage this technology, both for efficiency, but also just the future of finance, right? And so that's not only just the tokenization of an asset, but also how are we leveraging smart contract technology to bring efficiencies into just the processing of data and the standard types of things that exchanges and clearinghouses do on a day-to-day basis.
That's great. Thank you. It's been wonderful to hear where both of you are at, and we'll delve into that a little bit more. But before we do that, Simone, both gentlemen have been kind enough to reference a connection to us. So digital asset, and maybe I could ask you to expand on that a little bit. Digital asset recently announced the creation of Canton Network with a number of leading financial institutions and other industry organizations, such as the two colleagues we have here today. So for everyone, just to have a grounding as we go on in the conversation, what is Canton Network, and why is it attracting this level of engagement?
Yeah, sure. So Canton Network is a blockchain network that we announced in May together with a group of 30 strategic partners. And I think we see a high level of engagement because I think contrary to other chains, we decided to build the application first and then launch the network connecting these applications. And so for the past 6+ years, digital asset helped major financial institutions and fintech player to build decentralized ledger-based application. And maybe I can give you a few examples. We have several multi-asset tokenization platform, one from Goldman, HSBC, BNP, for instance. They've issued bonds or funds in various jurisdictions in Asia, Europe, and in the US. We also have tokenized structured product with Deutsche Börse. In the syndicated loan market, we have a fintech backed by JP Morgan, Citi, and BAML called Versana. On the treasury repo space, we have Broadridge and many others. I think it's a pretty amazing achievement. I don't know any chain actually that has so many institutional finance use case in production. And Canton Network now allows to connect these applications together, and we start seeing very, very strong network effects. And this is why I think we have that flywheel for the adoption of it.
Yeah, no, thank you. That's a wonderful way to sort of set the stage for the technical aspects we'll talk through. If I could start, I want to pick up on the thread that a couple of you mentioned with regard to capital raising and debt servicing. So I know that what we're talking about here is much more broad than one type of asset class, but just to have a place to start where we can talk about some of the experiences from real world implementations you've already done. Tom, if we could start with you, and then Simone, if you could pick up right after. Could you share just a bit more detail on how digital issuance will improve capital raising and debt servicing, what you've seen from the 25 or so activities that you've had? What advantages does digital bond issuance offer compared to traditional financing methods?
Sure. So, and I think that John touched on one of the key points, which is the smart contract element of it. And I think that even then, we're really at the early stages of getting the benefits of smart contracts. But I'll get into it a little bit. So one of the things that we can talk about is how you manage risk, and part of that comes from the speed and efficiency that you gain from using using this type of environment. I've done some analysis even internally about how a standard bond issuance works from the time that we get the information from the issuer to the time that we deliver securities to an investor, and then from there on from the servicing of that asset in terms of corporate actions and coupon payments and things like that. And that transaction will touch somewhere in the neighborhood of 60 applications. So, and each of those applications, have a discrete process. It's their own data sets, and there's a one-way flow of the way information is conveyed. So the beauty of using a blockchain environment is that you take away some of those layers. Now you can't delayer everything, of course, and that those things can happen incrementally over time. But you certainly can delayer some of those things. And the crucial thing is that the starting point and the ending point are the same, meaning that the issuer and the investor see the same exact information. So there is no discrepancy from the time it starts to the 60 systems that it passes through to the end. Yeah. So that's one of the key things. And then, as I mentioned, and that's certainly a risk mitigant. And as I mentioned, the speed element as well. So what we found is that when we did an issuance that could take a minimum of 2 days in a normal environment, sometimes upward of 5 or more days. Some of the issuances that we did, the team was able to settle within an hour, and that's including all of the external steps that happen. So you think about
in the industry, right?
Unheard of. all the risks that you kind of take away, counterparty risk, system risk, all those things that get pulled out. So I think that's really where we're seeing the benefit. And again, with the smart contract element, it's really the tip of the iceberg of how you can improve the servicing and build new products. So that's what we're excited about.
That's cool. Great. Thank you. Simone, do you want to just add some thoughts to it from our side of the experience?
No, I fully agree with Tom. Clearly, the big advantage of using a distributed ledger instead of a traditional database is in the way information is shared. As you say, Tom, like everybody has the same information. You don't rely on traditional messaging of sending a CSV file or a fixed message anymore. The information is reconciled, and the various parties have the same information. So trade position reconciliation, for instance, is very, very much simplified. And it means that your tech and ops costs are reduced. So like a bottom line gain, your EBITDA just increases. I would add that in addition, when you have both the assets that is digitized and the cash, like as digital cash is coming, we're going to be able to do what we call smart contract composability, which means that the two legs will settle at the same time. And I think as Tom highlighted, this reduces your settlement, your counterparty risk. And you can expect kind of a significant reduction, I think, in capital requirement because the risks are lowered. And so not only you have an increase in your profit, but you have a decrease of RWA, which is what everybody wants, and you increase your return on equity. So it's pretty significant consequences of changing the technology.
Yeah, what you're both commenting on or touching on is a little bit of a theme of the ability to apply this technology and these types of solutions to this space is going to make I don't say the barriers, but the wall of being able to be able to use corporate finance activities in a broad way, maybe more available to more types of institutions and of smaller size. So maybe along the same lines, John, we could pick up on that. In TradeFi, it's often the costs associated with it, the issuance, and support from the market makers that have an effect on limiting growth or causing growth to happen. But so what are the advantages that you think a tokenization platform, or you guys are experiencing as a tokenization platform, could offer in terms of cost or time, or time to market or client experience that's different from what you have in the TradeFi examples that you have expertise in?
Yeah, I mean, I think you've heard a little bit touched on today already in the sense of, if just general amount, I think number one is time to market, right? So if you're able to bring something to market quicker, and then also just the timing evolve around just the settlement nature, the trading nature of something. If you think of the full life cycle not just the issuance or the minting or the tokenization of it, but then what do you do after? What do you do with it after? Where is it custodied? How do you move it around? How do you leverage that, whether you're using it as collateral somewhere or it's just sitting? I think the concept of being able to put that on chain and then move that, there's a lot of efficiency there. And so if you're able to lower the amount of time that you're able to do those different steps and leverage, potentially whatever it is you've tokenized for other purposes quicker, drives a lot of efficiencies just in the general course of action for someone that's potentially, as an example, using debt issuance, right? Maybe a very simple example could be tokenizing a debt issuance and then using that as collateral to trade derivatives, right? If you were to do that today, the process to do that kind of from issuing the debt, right, call it, to actually finding and using it as collateral for trading derivatives is complicated. And it takes a long time, and there's a lot of different parties, counterparties and third parties that are involved in that process, called from start to finish. And by tokenizing it and bringing it onto a blockchain, we're not only able to shrink the amount of time, right, to Tom's point, but also we're able to lower the amount of counterparties and third parties that are involved in the process, which just streamlines it, right? So it lowers operational risk, it lowers counterparty risk, it lowers involvement of legal teams, and all the types of processes that are involved really from start to finish. So really interesting as we're able to call it step one is tokenizing debt issues, and step two maybe is using as collateral and other aspects of trading activity. And so we're really interested in how we bridge that, call it from step one to step two.
Yeah, it's where all the post-trade becomes cool. I've heard someone say that the evolution of the market up until this point, that it was the creation of assets, the creation of derivatives, and many post-trade services transpired over decades. What we're about to experience now is having that same thing for digital assets transpire over years. So it'll be nice to see. Let's switch, if we could, to a different aspect of the market, because I think oftentimes we spend so much time focusing on the exciting new creation of these assets. Tom, if I could ask you, many current market activities are focused on just that: asset creation, asset issuance. But what I want to do now is talk a little bit, picking up on the theme that John just laid down, talk a little bit about the secondary market growing. What liquidity options are available now, or probably more interestingly, what do you think is going to be needed to be able to get sizable markets created?
Yeah, so I think that's really an excellent point, and it kind of it goes hand in hand with why seeing Cboe at the table is really a great step in this type of process, because what we see is when, as I mentioned, we started by issuing notes and products that by their nature are less liquid. So the equities markets already have exchanges, ATSs, things that operate fairly efficiently, at least from the starting point. Not always the things that happen behind the curtain, maybe not always as efficient, but there's quite an amount of efficiency in those markets. But what we see and what we're looking for is to be able to create more liquidity in the marketplace, to create greater velocity for the assets that we create. And one of the ways you do that is by having a partner and provider who can create that marketplace, and doing it in a way where you have real financial players who are there to make markets on both sides. So I think that's really critical. And when you need to get to scale, when you have institutional scale, you really need to be able to do those things. And it opens up the different types of assets that that you can trade in those marketplaces, and how it behaves. And I would also lean into a little bit what John was mentioning earlier about even the next steps in terms of collateral management and using the assets for collateral, because the liquidity, there's two ways you look at liquidity. One is from a trading standpoint, but one is from a financing and that type of thing. So repo, collateral management. And I say this, and Kelly, I know that you have a lot of experience in this space. The amount of effort that it takes, and in my prior life before I was in this job, I ran operations teams for more than 20 years. And among them was, our collateral management team. So, what John mentioned really resonates to me because I know what it takes to take collateral that we need to, use to collateralize a swap and move it from one, CCP to another, and the effort and the cost and the trapped liquidity and the trapped capital that gets caught up in that process. So that's the two things, and they really go hand in hand, I think.
Yeah, it's a good point. You're both making a really good point about the degree to which the current market model has any number of agents and intermediaries, interjected to be able to support the reduction of market risk and market participant risk and increased certainty in transactions. But as we start to shift to these technologies, is that same thing going to be needed, or a different model around it, which is, I think, what you all are focused on. So, John, if I could pick up on that, I want to get your thoughts on the same question, the development of secondary market liquidity, but on the same point, also just to delve a little bit more, because you kind of have this unique perspective on how the growth of a platform, CTP, that supports TradeFi's regulated approach to digital asset builds off the success that you've had on the crypto side with Cboe Digital. So I was hoping you could give a little bit of unique insight on that as well.
Yeah, and I think, to also lean into what Tom said, I think you nailed it, right? So you have the liquidity side of the fence, you have the collateral side of the fence. So, we operate kind of in both avenues in the sense that we have an exchange, to your point, Cboe Digital, which runs a spot and derivatives regulated cryptocurrency exchange, which is really kind of, in my mind, the start of where we can see other digitized forms of assets trade. Right, so we're a crypto native, runs 24/7, built on kind of the concept of interacting with these assets on the blockchain, and then we also do things very TradFi-like in the sense of proper CCP clearing in our clearinghouse, both for the same spot and derivative assets, and so the two kind of functions work really well to not only find potential opportunities for collateral, which in my mind will unlock liquidity, right? If you provide more than, obviously trading is a use case in the sense of, there's volatility, there's people that want to trade volatility or trade to trade. And so you're always going to have natural liquidity that way. But if you can find the full use case where you can actually use what you're tokenizing in the form of collateral, that naturally is going to create liquidity, because you're going to have people that want to get in and out of that, and there's going to be churn and there's going to be movement. And I think that powers really the ecosystem. And so when we think of kind of the full suite of that, the other piece of the pie is market data. And so if you think of all those three pieces and how they work in any existing marketplace today, whether it's very opaque or it's very efficient, those are really critical. And so by leveraging DLT technology, blockchain, data oracles, like Pith that Cboe's involved in, alongside the lines of Canton and the DAML framework, and stitching this all together, right? End state, where are we going? How we make all that work together, I think, is really powerful to be able to bring tremendous amount of efficiencies to very, what I'll call, opaque markets to start, right? I think Tom made a good point, like US equity markets, very liquid, very efficient markets, probably not going to be the first market we see move to digital. Maybe I might be wrong, but probably not the first market. But if we look at other opaque, maybe less efficient markets where, more transparency in market data, more transparency in trading, more ability to see value in collateralized or CCP involvement, and doing so on the rails of this new technology, I think is really interesting. And if we're able to package that the right way, obviously the brand and the involvement with Cboe, our relationship with market makers, with banks, with participants, we're able to leverage that, right? They're already connected. We already have relationship with them. How we can work with them along with the issuers and with the customers of these assets to bring these over, right, into a tokenized, more transparent world, I think is really interesting opportunity. And that's where we're focused.
Yeah, what I'm struck by is that you're talking about an approach to a market model that's more about these ecosystems of services, and I think that's the benefit that a lot of what we get by bringing the business goals that you all are defining, architecting, and delivering marries up against the technology that organizations such as us are working on. It really creates these new ecosystems, these new networks for financial services to be delivered. So Simone, can I ask you? John had mentioned this earlier. It's sort of weaved in, but similar to secondary market trading, digital assets are also going to need post-trade asset servicing. Now these guys have mentioned collateral management, which warms my heart a great deal. But can you talk a little bit, Simone, from what we're seeing, what activities are underway to support the post-trade asset services on these new assets that are coming to market?
Yeah, we clearly see a need for, I think, cash on ledger. Like when you have a greater amount of secondary market, you have more trades, potentially smaller ticket size, and you have like on the post-trade size, whether it's corporate action, coupon payments. Really, the key piece, in my opinion, is being able to have the cash also on ledger. And so we do see a lot of activities in that domain. For instance, the RLN project, Regulated Liability Network in the US, released recently its conclusion of phase one. I think that's pretty interesting. We were happy to be the tech provider to that group. And we also work with several banks on tokenized bank deposits. And to me, this is a key enabler for the whole ecosystem, for post-trade, for secondary market. Having cash on ledger in some kind of form will be key to get there. And similarly to what John and Tom said, I do think that collateral and margin call and ability to use a smart contract to pledge and release assets in a kind of a programmable way will bring a lot of efficiency. And kind of the next step will be taking that and using this tokenized asset as underlying for derivatives. And to John's point, like the need of having fixings in market data on chain, the need of having, I don't know, credit ratings on chain to monitor the covenant on the CLO, for instance. This is kind of to me the next step and what is coming, and we do see some activity there. But going back, I think the most important in the short term to get a bigger adoption of the technology is to have cash on chain. That will trigger, as we say, like secondary market and efficient post-trade asset servicing.
Got it. That's super helpful. Thank you. John, you mentioned it earlier, just before we move on. Anything else that you wanted to say about asset servicing? I would imagine that to some degree organizations are sort of clamoring from Cboe to be able to have that be part of your ecosystem. But anything else to add?
No, I mean, I think what Simone and Tom mentioned, I think really nails it here. I love the concept of cash on chain. As if I look at the crypto side of the fence, right? Rails getting cash into crypto is obviously a thing we've seen grow over the last 5 or 10 years, really. But it's still a problem, right? And if we look at it very regionally, it's an even bigger problem because the U.S. is still the king. The dollar is still the king in the U.S. at least, but we see stable coins called like USDT and USDC gaining steam offshore. And really, what's going to be the winner? I'm not going to use terms whether it's going to be a stable coin or tokenized deposits or whatever, but finding a way to represent cash liabilities, call it, or something like cash on chain, I think is going to be really powerful and really a need in order to help facilitate the folks' access in order to be able to deal with whatever it is that is going to be tokenized.
Yep, fair enough. So this has been great to have these conversations and talk about a number of the really positive outcomes and the benefits. We just also want to be really real and insightful in this type of conversation. So can I turn a little bit to just ask each of you? Tom, we'll start with you. Are there any limitations or challenges associated with the creation of these platforms? Like, for example, for digital bond issuance that investors should be aware of, just things that that the industry, maybe to say it a different way, is still working through on its path to growth.
Sure. So I mean, I think that when we talk about the liquidity piece, we talk about that's what's possible and what could be, but we're not there yet. So when you think about the issuances that SG Forge has done so far, even though they're available 24/7, and even though theoretically it's available to be traded in that way, it's still OTC products. It's still not as not as liquid as you want it to be, and you have to take those steps. So to issue the product first, to build and then to have the liquidity platforms come along afterwards, I think makes sense. So it's just we're at maybe the walking step. The other thing I think is the the network component, and that comes both from the participants in a particular network. They're being able to have this interaction, and Simone talked about that a little bit, between what's available, what will become available on Canton, and not only the networks themselves, but when I say the network, I mean the types of players that are there in the space, and that's really crucial too. And that comes from I was talking to an asset manager recently about their ability to do custody. And so, they want to have a seamless custody experience with, knowing that we're going to have traditional assets operate alongside digital assets. And, to have those type of things, those are the steps that need to be taken. And, they have not been accomplished yet, for sure.
Yeah, those are great insights. John, what would you like to add?
Yeah, I mean, I would echo exactly what Tom said. I think there's still a lot of work that we have to do in terms of, call it, market infrastructure, focused on digital, whether it's cryptocurrencies, digital asset securities, whatever you want to call them, or all of them, to really see continued growth and adoption, and to kind of see that hockey stick almost effect in terms of interaction from different participants. So a lot of work, I think, as an industry, we have to do, right? There's not just one person that can lead this effort or solve this problem. We have to figure out how to work together and solve it. The other aspect I think that's really important is regulation, and it's probably talked about too much maybe, but it is so important, because there is still a lot of focus on call it cryptocurrency regulation, and how that may or may not impact digital asset security or non-security regulation. I think is really important. How the treatment of assets, depending on the different blockchains they may or may not be on, could be different, and how that could impact it. I think Tom mentioned, OTC versus kind of centrally cleared assets, and whether or not digital assets are treated differently than, call it, current assets, just because maybe, going back to my original point, the market infrastructure isn't fully there yet, all has implications. SAB 121 and things like that all have implications on how participants are choosing to interact with this new, not only technology, but these new assets that are being minted or being represented on blockchains. And so we need to figure out as an industry how to continue to move the needle prudently, right, but still innovating, so that way we can continue to see really very liquid, very deep, very trustworthy markets in the U.S., which has really been the cornerstone for the U.S. financial system and industry for a long time.
Yeah, ultimately, it's how we can sort of rely on the stability that you're talking about. Simone, thoughts on your side? What people should be thinking about as still challenges to overcome?
Yeah, no, I fully agree with Tom and John. I think it's still early stage. We talked about regulation. We talked about cash on chain. I think these are two key topics, of course. I would just give an example. Like, there's a big difference in terms of adoption. Like, whether it's the investor or custodian, some already have a node connected to a chain, and some other are very far from there. And I think what it means is that we're gonna have to live in a kind of a hybrid system for a while, and this is costly. Like, you don't get the full benefit until you have really migrated away. So we were talking about simplifying on reconciliation and things like that, and personal process. But as long as you kind of have both processes that are running in parallel, you have to realize that this is going to be actually more costly than before. And this is why we kind of need visionaries to make the strategic investment to get that up and running. And this is honestly a challenge in the current kind of cost-cutting environment that everybody is in. So I think that the fact that having to run the two systems in parallel is an additional challenge.
Yeah, thank you. All right, well, I want to just conclude by asking for a little bit of insights. We've talked a bit about regulation here, but just some more broadly on activities you guys are doing in the marketplace. So John, you were recently named to the CFTC's TAC, the Technical Advisory Committee, and the Digital Asset Subcommittee. Can you just give a little bit of insight on the group's goals and what it's focused on?
Yeah, no, it's great, and I'm really pleased to be able to work with my colleagues on the committee. and thankful for the CFTC's nomination there. And so very excited. So the committee is focused on kind of the intersection of a lot of things we're talking about today, right? Call it policy, call it law, regulation, and financial markets and technology, right? So everything, that we covered today is really in scope for the TAC. And so some of the things we've been, at least in the near term, focused on are called cyber resiliency, DeFi applications, artificial intelligence, while not maybe near and dear to tokenization, all really interconnected to how we see financial markets move more and more into, call it this new technology, right? Even though we are, a lot of financial markets are very fintech, right? Moving into TLT blockchain type of technology really is another step further. And so all these things are really important. So we're focused on that. And then also making sure that we can continue to keep the laws and the regulation up to date with the new technology, right? So sometimes technology leads the regulations. And so we need industry groups like the TAC to get together to really figure out a way to make sure that we can properly and prudently, but also open arms embrace technology for the benefit of the end customer.
Oh, sorry, I think I cut out there for a second. Thank you. So Tom, the very same committee has the benefit of your insight and wisdom and presence as well. Can you talk about that from your perspective? But I do want to go back to the point where you have been involved in so many issuances across the market, just your perspective on regulatory considerations or compliance or anything in that controls environment.
Yeah, and I think the things actually go hand in hand. So as I mentioned earlier, SG Forge, last week was granted a digital asset service provider license. And that really comes from the EU and France in particular, being ahead of the curve, in respect, at least to the United States, with the regulatory outlook and how they're looking forward in the market. So given that, and given our size and scale in France, we've been able to collaborate with the regulators, collaborate with the central banks to be able to to demonstrate how these things can work in a controlled way. And one of the things that the team has done is developed what's known as the CAST framework, which is an open source framework that kind of lays out the way that we can and should operate. And this skews more towards say public blockchains than permission ones, but it still it kind of defines the rules of the road. And that leads into, as you mentioned, I think that the CFTC and Commissioner Caroline Pham has done really a wonderful job of bringing a super group of people together to think about how the industry should be, what the framework should be from a regulatory standpoint, from a governance standpoint, from a best practices standpoint. And those are some of the things that we're working on to really be able to demonstrate that we can use this technology in a safe and sound way, the same way we do with other types of technology. And that's really the goal. So I'm really looking forward to the work the committee and subcommittee is going to do over the next coming months.
That's fantastic. Thank you both. Simone, why don't I give you the last word? Just in creating the technical infrastructure for Canton Network, what were some of the considerations from a regulatory perspective, or really more to the point, how has an organization such as us engaged with regulators that are supporting the market more broadly?
Yeah. So clearly, our goal as a tech provider is to provide a technology to our client that will allow them to do their business in a compliant way, whatever the jurisdiction. And it's true that there's a broad set of constraints, whether it's in Europe or the US. I think it's clear that it's not exactly the same constraints. If you look at what the OCC says, for instance, is that you need to demonstrate, I think, appropriate operational technology and compliance risk management framework. And Canton has been designed to allow to implement such risk management processes. And it's really to allow our client to convince the regulator that they're operating in compliance with the regulatory framework. So if I go a little in the details, with Canton, you have a known validator set, which means that similarly to a regular trade, let's say the issuer, the buyer, the custodian are the one validating the trade, not kind of a random set of mining companies that you could have on some permissionless public chains. So that's something the regulator kind of likes. We presented our framework to some of the regulators, and they kind of have a relief when we explain that the validator set is a known one. Similarly, at the smart contract level, you can implement some transfer restriction, and that really helps being compliant with like KYC, AML, CFT requirements. And on the technical side, like how do you mitigate the tech risk? The Canton network protocol allows for an application to be run on dedicated nodes or dedicated servers. It means that whoever runs a given application has full control over these servers, and that means that if something else happens to another part of the network, that will not impact the SLF or the settlement of a SocGen bond on the Cboe exchange, for instance. And that's something very critical, that the infrastructure is resilient. And so we've been designing our protocol with regulated industry in mind. This is why we have a fairly different design as other chains. And this is what I think allows many of our clients who are regulated institutions to be able to move into production, even in the most constraining jurisdiction like the US.
Great. All right, well, with that, gentlemen, thank you so much for your insights. I think it was a really wonderful and practical level of dialogue that I hope everyone who's listening in really benefited from. I know I certainly did. And so with that, I will thank you all for joining this session of Conversations from the Edge and wish everyone a good day.
Thank you very much.
Thank you so much.
Thank you.